points on the lesson. Live in the hills, but I still get a spread. Started with a little, but I still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, I want to talk about how inflation can crash the stock market. If you've been active in the market in 2021, I'm sure you have heard this word inflation come up. And a lot of people ask, wait, how is this bad? I thought this would make certain prices go up, even like assets. And that is true for the most part. But when you start to see it in big amounts and consistently, it has some implications. Now, I am not making this video as a bearish video. Actually, to the contrary, it's looking at both sides. You know, I really think a lot of people could learn stuff from this because it brings us way back in history, because the last time we even saw signs of rising inflation, it was back into the 80s and even to the 70s. As of the modern generation, you really haven't seen much happen because of what has really been going on with the Fed, the policy, the money, all of that. So my point of this video is so you guys could learn. If you do not learn anything at the end of this video, I would be very, very surprised, because even though we are living in a new modern era and there's a lot of things that have happened, especially in 2020, as you dive deeper into this topic and if you look at what has happened over history, you will see there is a lot of common factors. So I want you guys educated, and more importantly, if you know how to spot the weakness, that will give you your signs. However, if those signs never appear or you really don't spot the weakness, that is essentially your green light to invest. The point is to not be afraid of the boogeyman and not make investments and not look around, because if you really go through the history, all of these events take time. So I just really want you guys to know what a real warning sign looks like. And then as the situation develops, you will know, hey, is it safer or could we see some more problems? So I'm going to be jumping around a little bit in this video. I have a nice Investopedia article. I'm going to be going over some of the main points. I want to talk about what the great inflation of the 70s was. Then I want to talk about the stock market crash of the 70s. I'm going to take you back a little bit to the market of 2000 and the 2001 stock market crash. And then we're going to tie that here into the yield curve. And you can see how that compares with the rest of the kind of more modern drops and crashes that we have seen. And then finally, back to the E-Trade, you could even see here, we have the data all the way from the early 90s, because as far as the 70s and 80s were concerned, you really did not have data on computers and trading like we do today, believe it or not. So hopefully you guys learned something from this video. Hopefully you enjoyed. If you do, drop your thumbs up on the video, and do not forget, we are live every morning streaming, youtube.com/thestockmarket. If you want to watch us trade, if you even want to hear about this, I did bring this stuff up on stream, or if you just need the news, questions, I don't know what it is, but hopefully we see you there. So right off the bat, the first thing I want to highlight is actually the 1973-1974 stock market crash. Why? Because this was a crash that lasted for pretty much about 12 months, a little bit longer. But the funny thing about this little crash here that a lot of people ignore is that this crash was literally one of the worst stock market downturns since not only the Great Depression, but the 2008 financial crisis. Now, why do I say that's surprising? Because a lot of people bring up 2000 and the stock market bubble when you start looking at modern crashes, but when you look at the amounts and the effect that it had, what happened in 1973 was actually very, very large on the scale of all the other movements that we've seen. And then when we get into 2000 and you look at the 2001 crash, and you've even heard this from the Fed, and I really do agree with this, that crash was caused by pretty much over leverage and high valuations, but it wasn't something where it was caused by an underlying factor. That was just people kind of gambling. Valuations were too high. A lot of stuff happened in 2000 and 2001, even 2002, everything from 9/11 to SARS to Enron and all of this stuff. There was just a pile of just bad info that eventually clapped the market, but it wasn't one of these economical factors, which is what we saw in 08, the Great Depression, and now the 1973 stock market crash. So, like it says here, it caused a bear market between January 1973 and December 1974, affecting the major stock markets in the world, particularly the United Kingdom. It was one of the worst market downturns since the Great Depression, the other being the financial crisis of 08. This came after the collapse of the Bretton Woods system over the previous 2 years, with the associated Nixon shock and the United States dollar devaluation. Under the Smithsonian Agreement, it was compounded by the outbreak of the 1973 oil crisis in October. It was a major event of the 1970s recession. So this is giving you the summary of it. We will dive a little bit deeper into it, I'll tell you, but one big factor that you could kind of see if you want to even look at some things and how they played out, it was 694 days between January 11th, 1973 and December 1974, but the Dow Jones lost over 45% of its value during that time. So one big thing was the year before that, the Dow Jones actually did really good and had a 15% gain on the 12 months. So coming off of 1972, things were were actually looking really, really good. But then it says in that 2 years from 1972 to 1974, and hopefully you can understand how time takes these effects and even apply that here to today. The American economy slowed from 7.2% real GDP growth to negative 2.1% contraction, with inflation by CPI jumped from 3.4% in 1972 to 12.3% in 1974. So this is something we're seeing right now in May 2021. A lot of people are getting shocked about the April CPI. That's why we're wanting to see what's going to happen next month. Is it going to be transitory or not? But even some people are saying, oh no, we could expect 20% now. If we expect 20% inflation, CPI, whatever, just because the market expects it doesn't mean that it doesn't have an effect on the underlying economy as well as even the stock market. So another little factor that I thought was actually very, very important in here was that the UK lost 73% of its value. They did very, very bad, but even then, the United Kingdom, the crash ended after the rent freeze was lifted in December 1974, allowing for a readjustment of property prices over time, and then stocks did bounce 150% after that. So don't ever forget that here. Most of these crashes, even when we go through history, you can't forget all those crashes led up to where you are right now. So I hope you guys realize here that the point of being educated and understanding this stuff, if you want to be a really, really productive investor here, is to take all of this in and make the right investments, especially over a long period of time. But it's not about being so bearish all the time as much as it is just understanding what is going on in the world right now, as well as what has happened. So now let's get over here and talk about how the great inflation of the 1970s happened. How did this all happen? We started with the crash. I wanted you to know how important it was because it was one of those large ones. But now, what caused that inflation, especially when we look at it here in 2021? Most people know, or people have an idea of what caused it. You went through all this stuff in 2020. You had government spending, and now people are talking about supply chain issues, not getting the items. That's why. Is it going to be transitory or not? And if it doesn't, well, that's where you start looking into this stuff. You have the Great Depression, you have the Great Recession, but a lot of people ignore the Great Inflation. So as we start, this is, again, I brought this up the first time people started talking about inflation because I said, hey, if it gets crazy, this is starting to look like the 70s, but a lot of people don't know what happened there. And like it says here, it's the 1970s. The stock market's a mess. It has lost nearly 50% over a 20-month period. And for close to a decade, few people want anything to do with stocks. Now, compare this to 2000, compare this to the 1970s now, and even today, a lot of people want to do stuff with stocks. Either you've been subscribed to this channel for a while, or some of you have just gotten into it in the last 12 months. And you even see these meme stocks, you see the younger generation, all this. Depending on how this plays out in the long run, you will see that does have to do with psychological effects and market psychology. This comes into it. So it talks about how economic growth is weak, rising employment, but now the easy money policies of the American Central Bank designed to generate full employment in the early 70s also resulted in high inflation. Now, compare that today, that is exactly what we have now. You have easy money policy. They're literally handing out money in stimulus checks or giving out forgivable loans, all of this different stuff, not to mention where the interest rates are at, the Fed lending facilities, all of this stuff. But like even Jerome Powell would say today, this is to spur and get us back to full unemployment. If you've been watching Jerome Powell in 2021, he wants inflation to stay consistently above 2%, know that it's not going to be transitory, but then he wants to make sure we get back to full employment. This is one of the big tasks most governments are tasked with, and that's how the central bank comes into play. So this is what led to inflation, but it says the central bank, once under different leadership, would later reverse its policies, raising interest rates to some 20%, a number once considered usurious. For interest rate sensitive industries such as housing and cars, rising interest rates cause a calamity. With interest rates skyrocketing, many people are priced out of new cars and homes. So we will keep coming in here and you'll get to see some of the key takeaways. Period of rapid inflation occur when the price of goods and service in economy suddenly rise, eroding the purchasing power of savings. In 1970, saw some of the highest rates of inflation in the United States' recent history, with interest rates rising to nearly 20%. Central bank policy, the abandonment of the gold window, Keynesian economic policy, and market psychology all contributed to the decade of high inflation. Now, this is one of the bigger keys that you will see here, and that does make a huge distinction, in my opinion, between 1970s and now, because you are missing one big fact. In 1970, they abandoned the gold standard. Right now, your dollar is valued amongst every other currency in the world. It's based on what you could get. Back in that time, prior to this great inflation in the 70s, $1, you could have took it into a bank, you could have transferred it in and gotten gold back for your money. It literally had a fixed value. We were operating on a fixed exchange. That is not not the case since following the 70s. So that's why when you look at what's going on today and you could see 1970, like, wow, there's a lot of comparisons, but this is a huge, huge factor, and we did not see anything of that scale in the last 5 years or let alone decade or 2 decades. And on that note, another point that we're going to get into, and I will show you exactly what I kind of expect to happen, because once you understand this whole story, I will be able to give you a little bit of my guidance coming into the future here, but raising rates is actually going to be a key factor of all this. This is why this is an article from CNN Money in 2000. This is from the archive, but even tying it into today, and this is why anytime people say the I word, inflation, we haven't seen it in so long, but it is very important because this has to do with prices going up rapidly. So you've seen it in the stock market, but now you're also seeing that happen in a lot of places here today in 2021. But what happened here in March 2000, and keep this date in mind, I'm going to go to the yield curve at the end of this to show you, the Federal Reserve lifted interest rates by another quarter point, the 5th increase in less than 8 months, in an effort to slow the seemingly unstoppable U.S. economy, ensure prices for goods and services remain in check. So what I want you to understand here is that throughout history, this is the importance of rates going up or down and how they use it to adjust aggregate demand. But this is why it's so important back then and even today in 2021. Anytime you start talking about prices going too crazy or inflation, the Fed and rates are going to come back into play. So keep that in mind. But now the interest rate casualties. This is the gruesome story of the great inflation of the 1970s, which began in late 1972 and didn't end until the early 1980s. So in Stocks for the Long Run book, A Guide to Long-Term Growth, shout out to long-term, baby, Warren professor Jeremy Siegel called it the greatest failure of American macroeconomic policy in the post-war period. So this is a dead giveaway here, because one thing people don't understand, and this is why I look at it a lot, you could see what happened in 2000 in the 2001 stock market crash. A lot of people try to compare that here today. Again, you see the big run up, you see the big drop, but this one wasn't really a policy error. This one wasn't due to policy or anything like that, as much as it was high valuation, speculation, and people getting into it, now mixed with a host of a bunch of bad news at the start of the century. That's why when you come over to 07 and 08, this one had to do with over leverage, but a lot of people would even just blame the banking policies and regulation. But even then, how the Fed and the government reacted to this situation was part and part why you saw such a big drop. But really, I don't think this crash is anything like this, although this crash did tie into this, and now this move ties into everything we're seeing here. And if you haven't watched that video I made on this already, you should go check it out. Someone posted in the comments. But the great inflation was blamed on oil prices, currency speculators, greedy businessmen, and avaricious union leaders. However, it is clear that monetary policies, which financed massive budget deficits and were supported by political leaders, were the cause. This mess was proof of what Milton Friedman said in his book, Money Mischief: inflation is always a monetary phenomenon. So even then, looking at the reasons and tying it in today, you have oil prices rising back then, currency speculators, we see a lot of speculation today. You're seeing the commodity reflation, greedy businessmen, I guess we've seen that for a while, and then now union leaders, jobs, and all that. You've been seeing this push even lately. These factors were obviously a little different back then, but on the broad sense, you kind of see that here today. So it goes on, it says how the treasurer at that time had no formal economics trader and he declared bankruptcy, but then it says, yet these unusually bad economics times were preceded by a period in which the economy boomed or appeared to boom. Many Americans were awed by the temporarily low unemployment and strong growth numbers of 72. Therefore, overwhelmingly re-elected the Republican president Richard Nixon and their Democratic Congress. In 1972, Nixon, the Congress, and the Federal Reserve eventually ended up failing them. So how and why? Upon the inauguration in 69, Nixon inherited a recession from Lyndon Johnson, who had simultaneously spent generously on the Great Society in the Vietnam War. Congress, despite some protests, went along with Nixon and continued to fund the war and increase social welfare spending. In 72, for example, both Congress and Nixon agreed to a big expansion of Social Security just in time for the election. Nixon came to office as a supposed fiscal conservative. Still, some of his advisors would later classify Nixonomics as a conservative man with liberal ideas. Nixon ran budget deficits, supported an income policy, and eventually announced that he was a Keynesian. So to understand that difference, it says it very, very artfully here. John Maynard Keynes was an influential British economist of the 1930s and 40s. He had advocated revolutionary measures. Governments should use counter-cyclical policies in hard times, running deficits in recessions and depressions. Before Keynes, governments in bad times had generally balanced budgets and waited for badly allocated business investments to liquidate, allowing market forces to bring about a recovery. So if you don't understand what this means, up until Keynes in the 40s and now even when Nixon started to really apply this, and this is what led to some of this inflation here, governments used to operate a lot more just pure capitalistically, because when things would go bad, if there was a recession or depression, instead of spending money and then using counter-cyclical measures, doing stuff opposite to failing, businesses are getting dried up, they're not making money. So counter-cyclical would be pumping it or cutting the rates, doing stuff like that. They used to just literally say, okay, we'll wait till things balance out, people get flushed out. If they can't hang, they can't hang, and well, then we'll be able to go back to normal. Nixon's other economic about face was imposing wage and price controls in 1971. Again, they seemed to work during the following election year. Later on, however, they would fuel the fires of double-digit inflation. And again, double-digit inflation is really the key because that is when inflation really starts to get aggressive. So even if people say 20% today, you do not want double-digit inflation. Again, 1970s, it was 12.5. Once the price controls were removed, individuals and businesses try to make up for lost ground. Nixon deficits were also making dollar holders abroad nervous. There was a run on the dollar, which many foreigners and Americans thought was overvalued. Soon they proved right. In 71, Nixon broke the last link to gold, turning the American dollar into a fiat currency. The dollar was devalued and millions of foreigners holding dollars, including oil barons in the Middle East with tens of million petrodollars, saw the value of dollars slash. So then it talks about winning elections because, again, a lot of people argued even Nixon during this time did what he did simply to keep people happy and to win the election. That's where even you get comments from the Fed and even what people would say. A lot of people during this time even argued that even though the Fed was independent, this was a time where you really got to see the Fed used by the government to kind of accomplish their purpose more explicitly than non-explicitly. I know some of you will argue that. So I'm going to skip ahead here and just bring it to the bottom line. It would take another Fed chair and a brutal policy of tight money, including the acceptance of a recession, before inflation would return to low single digits. Once they hit the inflation, it was really hard to come by, and that's where we're going to get into the next topic. But in the meantime, the U.S. would endure jobless numbers that exceed 10%. Millions of Americans were angry by the late 70s and early 80s, yet few remember Burns, who in his memoirs, Reflection of Economic Policy, blames others for the great inflation, without mentioning the disastrous monetary expansion. Nixon doesn't even mention this central bank episode in his memoirs. Many people remember this terrible era, blame it on the Arab countries and oil pricing. Still, the Wall Street Journal, in reviewing this period in January 86, said OPEC got all the credit for what the U.S. had mainly done to itself. So this is what brings me to my final point here, because if you see all this, I had to explain this whole story for you. I hope you enjoyed listening to it more so than reading, and then my little comments with it. But at the end of the day, that was almost a 10-year process, and you could see how it took time. So is the stock market going to crash now? I don't know, but hopefully you could kind of see that there is a game plan. So although there might be some hiccups in between, realistically, you are going to see actions with the rates, if anything. Now in 2021, we only had 2 months of this inflation. People are going to wait for more and more months. Again, that might be a whole nother year before people could confirm that it's transitory or not. And then, like I mentioned earlier, Jerome Powell gave you what he was looking for. He said we need unemployment back at a level, inflation above 2% and strongly above 2%, and then he needs to verify that it's not transitory. If all three of those things are met, they will begin raising rates, or if they see things are getting too hot, or not really just the stock market getting hot, but a lot of other prices now start really going high, or a lack of stability across all price metrics, raising rates is going to come into play. So this is why I'm here on the dynamic yield curve, because essentially you can see here as prices start to really elevate, you will see rates go with it. That was 2008, but really, I think we have a little bit of the mix here in the 1990s, but not the same reasons why the 1990s or the 2000 market crashed, but you could see it here where the rates really did rise very rapidly for a period before they started raising, and then it eventually led to the cuts following. So again, that is what I'm looking for here, but now you see what we've been going through. You start to see the rates start to pick up here, and pretty much we're about halfway there. The next level is that now once that 10-year does something, this is why the 10-year is so important, it will start to affect the 2, 5, and 7s. And then if that starts to rise up, well, it might kind of look like this, where you see, even in the 2000s, you had a pretty good period and the stock market was already up a lot, but the rates all started to rise up here, but the short term didn't really move as much until you start getting into the whole, okay, we got to raise 8 times. This was now early 2000. But even despite that, in the process, the market was still able to go up. That's what I really hope you guys could see about this, because now it wasn't until the 8th cut that you actually started to see the market come down here. And then by the time the market dropped, they flip-flopped that policy in 2000 and then began cutting again. So how will inflation crash the stock market? Well, as David Hume will say, just because you increase the amount of supply, it doesn't necessarily increase wealth or output or productivity. So there's a lot of things that inflation causes, but the main thing that we've been seeing and that we've learned throughout history is that that lack of price stability, which is usually caused by policy and then the follow-up policy, that is what could pretty much stop the productivity or have you having both low employment and then higher prices. That is pretty much the worst situation that you can have. So I hope this helps. If you have any more questions, let me know. I would love to make a follow-up on this, or hopefully we see you on stream and talk about this. But now I hope you really guys can see, even though we're living in a modern times, a lot of this stuff that you see in the stock market, there is a really, really big history to it. And most importantly, it takes time. You know, I got to explain all these stories, even 2000, the 2001 crash, even as everything was going up. Again, I'm showing you all the way up to what happened in here, but you still had a huge run up year after year. Even if there was a dip, they were raising rates all the way up throughout here. So things take time. And this is what I'm trying to tell you guys. Pay attention to the bigger economic factors. Again, employment, interest rates, the overall policy and the resulting effects, and understand the timelines with them, because now until you see it get to a certain point, until you see now policy tweaks and all that, you essentially will have a green light to a degree. So I hope that helps you guys. I hope you love it. Enjoy the rest of your weekend. Again, let me know if there's any questions, and have a wonderful weekend, baby. Let's go.